All right. So those are the three different analytical measures. I'm going to type it in the chat box. They call it analytical measures. To analyze comes from the word analyze. There's horizontal analysis. There's vertical analysis and common size statements. Can I ask a question of all of you? Has anybody gone to my YouTube channel? Could you
I
give?
have.
Who has? Who's that? Christopher?
Yeah.
How was it?
Yeah, I went there.
Were you able to access the video? Did I? Because this is all new to me. I don't know. I want to make sure you were able to get in and you were able to look at the video and all that.
Yeah, the most recent one that you posted, I was able to watch.
Oh, I'm so happy to hear that. How was it? It was good. It was no problem.
Yeah, it was fine.
Oh, I'm so happy. Glad to hear that. That's great news. So, okay, so let's take a look at something else. This chapter is full of different uh, equations to analyze things. And one of the equations, I want you to write this down because it's in your quiz, number 14. It's called number of days sales in accounts receivable. I'm typing it in the chat box. So here is how you compute this. Once you have the recipe, isn't it easy to make the food once you know how to put the ingredients and how to cook it and all? It's not so difficult once you have the ingredients. And that's what it is with a ratio or some sort of analysis equation. So the first thing is the number of days sales in accounts receivable equals average accounts receivable divided by average daily sales. Okay, so that's how you compute that. And the answer will be shown in the answer is in days. How many days? So first of all, how do we compute this average accounts receivable? Does anybody have any ideas? Anybody want to type it in the chat box? Anybody want to unmute themselves? Hold on, we got to let somebody else in. Somebody else, let's see. Host, Cayman, Christopher Hendrick. Okay, invite. Okay. I see 5 people. 1, 2, 3, 4, 5. Okay, we're all in. Okay. I'm always afraid that I left somebody out there. Does anybody have any ideas on how to compute the average accounts receivable? Well, when you average something, usually you have to divide by 2, correct? Oh, that's okay, Hendrik. Don't worry. I'm happy you're here. To me, I'm thrilled that you're here. So the first thing you're going to do is you're going to take the beginning balance of accounts receivable. Now, does anybody remember what accounts receivable is? And when I say what it is, I mean, is it an asset, a liability, or owner's equity?
Asset.
Yes, it is an asset. You take very good. You take the beginnings account receivable balance, and then you take the end of the year accounts receivable. You add them together and you divide by 2. Okay, so I'm going to give you some numbers and I want you to try to compute what the average accounts receivable is. So get ready to write. So let's see. The beginning accounts receivable is $45,000. 45,000. The end of the year accounts receivable is 35,000. 35,1000. And the number of days in the year for purposes of this calculation is 365 days. So knowing that, let's see. All right, that's for the next, I take that back. We're going to do that in the next thing, the average daily sales. We'll need that 365 days. So could you take the beginning accounts receivable and add it to the end of the year accounts receivable, divide by 2, and type in the chat box what you get? Is anybody driving and they can't deal with the chat box today? Anybody in the car driving? All right, so very good, Kanan. Everybody else I can't see. I see you, but everybody's camera shy. So could you please type in the box your answer? You're computing the average accounts receivable. Good. Very good, Cayman. Very good, Christopher. Nidell, Hendrik, what do you think? Good. I just don't feel well today. Oh, okay, Nidell. I'm sorry. Okay, just take it easy, all right? We'll help you. So now we know that the numerator of this number of days sale and accounts receivable is 40,000, right? So the numerator is 40,000. We just computed that. And we have to divide it by average daily sales. So how do we do that? So average daily sales, they give us the number. The number is, they give us the sales. The sales are 584,000. The sales on account of 584,000. On account means credit sales. So how many days in the textbook year, scholars? How many days in the textbook year? All right, wonderful. Very, very good. 25, good, Cayman. Very good. All right, but what is very good, Cayman? But what's 584 divided by 365? What number is that? Could somebody do that, Cayman? I heard from you enough. You're doing a good job. 1,600? Does everybody agree 584,000 divided by 365? Okay, so 40,000, very good, divided by 1,600, and that comes out to 25 days. Okay, 25 days. Let me just read what this means. Now that we have the answer, let's see what it means. Just because we got the answer, now we got to know what we got to do with it now. Oh, this book is going to kill me. I keep getting beat up by this textbook. It lands on my knee. Okay. Hold on. I'm looking. It's called number of days. Let's see. Number of days, 675. It's on page 675, just so you know. The number of days sales in receivables is an estimate of time in days that the accounts receivable has been outstanding. So that's not terrible because people usually have 30 days to pay. So that's good. The 25 days is good. In other words, receivables should have been collected in 30 days or less, but were collected in 39.5 days. That's the example in your book. Although collections improved in 2006 or 26 to 28.6 days, there is probably still room for improvement. So we're good. We're under 30 days, so that's okay. The accounts receivable are being collected timely. If it was over 30 days, would we be a little bit concerned? You know how to react and raise your hand? You know how to do reactions? I think you go to the chat box and I think you're able to, there's actually reactions somewhere. Or you can go to the chat box and you can actually raise your hand, I think. Let's see.
I only see the clapping one. I don't see the raise your hand.
You know what? Then put the clapping one. Thumbs up, clapping. Oh, good. As long as I know that you're hearing me. Okay, so now we have another calculation we're going to talk about. After we get done with all this, we're going to go to the quiz itself. But right now, we'll just get through this. So price earnings ratio, P/E. And if you picked up a Wall Street Journal, you would see this P/E. So this is something in real life. This is not just an academic calculation. It is the PE ratio. I'm going to type it in the box. Okay, the PE ratio equals market price per share of common stock, not preferred, only the common stock, divided by earnings per share on common stock. That's how you figure this out. All right, so I'm going to, now that you have that ratio, now that you have that equation, can I copy this? I'm going to give you two items and I want you to calculate the PE ratio. So the market price is $25 and the earnings per share on common stock is $1.25. So based on those two numbers, please calculate the PE ratio. And type it in the box, please. Let me see. 20, very good. Very, very good. So what is this price earnings ratio equal? The price earnings ratio on common stock measures a company's future earnings prospects. It is often quoted on the financial press and is computed as follows. We did just what we had that equation. PE ratio is the market price per share divided by the earnings per share, and it deals with the common stock only, not preferred, not any of those fancy stocks. All right, let's go on to talk about something called audits and internal control and Sarbanes-Oxley Act of 2006. So public corporations issue annual reports, such as Pepsi or Coca-Cola or Amazon. They're traded publicly. These reports summarize their operating activities and their plans for the future. In addition, the financial statements, meaning the balance sheet and income statement, there are also accompanying notes to the financials. They call them disclosures. So I'm going to type that in the box. Disclosures are notes to the financials. So the notes tell a lot of information. Sometimes there's more information in the notes to the financials than in the actual numbers. It always reminds me of those books. I see them in the supermarket. You know, people who get hooked on those soap operas, they have these digests at the supermarket that you could buy in case you missed an episode. And it has all these notes of what you missed. And that's what I think about when I think of the notes to the financials. It's like things that are not in the numbers that you have to read between the lines, and it kind of cues you in. So there's also another report called an MD&A. Remember I told you accountants love to abbreviate? And that's a management discussion and got the rest of it. Management discussion and analysis. That's what that is. It's management discussion and analysis. It just tells a story about what the company's doing and what their plans are. And there's also a report on the internal control. And that's prepared by the auditors. So keep that in mind. This is something you want to write down because you might need it when you're doing the quiz. The report by the auditors is on the fairness of the financial statements. The CPA firm's opinion, the opinion of the CPA firm is written in the form of a letter. And you either get a good letter or a bad letter. There's a qualified opinion and there's an unqualified opinion. So let's continue on. So let's talk about the Sarbanes-Oxley Act. This act was in 2002, and it's a report on internal control by management. The report states that management has a responsibility to establish internal controls. They have to lock up the ledgers. They have to make sure that there's passwords on the computer. They have to lock up equipment. They have to have a security guard for inventory. These are all internal control procedures to protect the assets of the company. Now, Sarbanes-Oxley, the way that this act got its name is because it's named after two gentlemen that came up with this idea. One of them is Senator Sarbanes, that's this man over here. And then there was Commissioner Michael Oxley. So what is the purpose of this act? And then, by the way, President Bush signed this act into law, became a law. So what does it do? It protects investors by improving accuracy and reliability of corporate disclosures. Remember I told you about the notes to the financial? They call them disclosures. Does anybody remember Enron, or is that too long ago? You guys were probably young children. Something happened that was very changing. You know, it was like a turning point. Enron, it was an Enron what I call debacle. And not only, the worst part about it was that the accountants were in cahoots with this with this company, because accountants are supposed to be the public watchdog. They're not supposed to take sides. They're supposed to be there watching out for the public who's investing in these companies. But in this case, their accountants were shredding faxes and they were shredding different things. They were basically doing unethical things. So this act has 11 sections, and it says it right here. It was created as a result of major corporate and accounting scandals. I encourage you to look this scandal up. Tyco International, WorldCom, and Peregrine. But Enron was the one I remember because I was reading the newspaper at the time when this was going on. So Title III, it's a corporate responsibility, places responsibility for the accuracy and validity of the reports on management. Okay. So that's that. Any questions on this act, on this Sarbanes? You know what they call it for short? because you know, accountants, they don't like to, everything's got to be abbreviated. They call it socks, not the socks you wear on your feet, just socks, SOX. So on page 688, we have various measures of, in this chapter, a lot of them. And on page 695, there's a nice listing of all these equations and analyses, but they boil down to three different types of measures. There's something called liquidity measures. There's solvency measures. And there's profitability. Profitability measures. So liquidity evaluates a company's ability to convert assets into cash. So if I have accounts receivable, money owed to me by my customers, how quickly am I converting that accounts receivable to cash? How quickly am I collecting money from the people who owe me money, but they bought my product? It's one thing to have a sale, but if I don't collect from my customers, how good is that sale? Then there's solvency measures. That measures the ability of a company to pay its long-term debts. So solvency is important. And they look at that solvency equation when someone is filing for bankruptcy. All right, class. Any questions on what I've gone over so far? Any questions, anybody? You good? Because we're gonna change gears, and we're gonna go right into Canvas. So bear with me while I log into Canvas, and I'm going to change the screen so you could see it. I'm going to do a new share. We're going to go into Canvas, and we're going to go right to this quiz and do this together. Now, I want to hear from you because I'm not going to give you the answer. You have to give me the answer. Ultimately, we'll see the answers, but I want the answers coming from you, not from me in this case. Okay, so let's find assignments. We're looking for quiz 14 or RA 14, which is the last quiz. We're almost done, guys. Are you excited about almost being done? I would be. So here we go. Let's go and take the quiz. So let's see. All right, let's see. Oh dear, it has the answers on there. That's not good. All right, let me read the question. Hold on, bear with me. Let me get my other magical book. I got all my books here. Bear with me, I gotta turn to the right page. So the percentage analysis of increases and decreases in individual items in a comparative financial statements is called A, vertical analysis, B, solvency analysis, C, profitability analysis, or last but not least, D, horizontal analysis. So please type in the box what you think is the correct answer. You can just put A, B, C, or D. And you will find this on page 667. That is correct, Christopher. The answer is horizontal analysis. And we talked about when you compare two different statements, and it had here comparative financial statements. That was where it gave it away. Okay, so let's kind of scroll down. So you see the answer? So which of the following is most useful in analyzing companies in different sizes? So we have A, comparative statements. B, common, oops. Yeah, very good, Cayman. Very good. You saved me a lot of typing. Thank you. Very good. So the answer is common size financial statements. Very good. And the common size financial statements are shown in terms of percentages. Very nice. So here comes 3. Uh-oh, I showed the answer. Pretend you didn't see that. So here comes 3. Percentages analysis, which we just said was common size financial statements, ratios, turnovers, and other measures of financial position and operating results are A, a substitute for sound judgment, B, useful analytical measures, C, enough information for analysis, industry for information is not needed, and D, unnecessary for analysis, but reaction is better. What do you think? Oh, thank you. Thank you, Cayman, is that you? Thank you. So please type in the box. Hendrik, Christopher, what do you think? B, very good, very good. So that answer is useful analytical measures. Remember, how many measures are there in the book? How many did they tell us? Do you remember in the beginning we talked about it? There's 3. Very good, Christopher, very good. So here's the next one. Cayman was good enough to put it on there for me. So here we go. Let me just go up there a little bit. So based on the following data, what is the number of days sale in accounts receivable? So we actually did this problem. Here's all the information. You have to take beginning accounts receivable, ending accounts receivable, and add them together and divide by 2. What did we get? We got 40,000, remember? Remember when we did this problem like about 10 minutes ago? So what is it? 45,000 plus 35,000 divided by 2 equal 40. But we're not done yet. Now we have to take the 40,000 and divide that by the sales divided by 365 days. So what does that come out to be? And it's going to be in terms of days. We got this answer before. Oh, 25 days. Very good. Yes. Good job. 25 days. Very good. All right. So now the following is available for Jace Company. All right. And the market price and whatever. Oh, yes. Good. So what do you think the answer is? We did this one before. Which of the following is correct? This is talking about the price earnings ratio. What do you think is the correct answer here? Possible answers are 7.3. I think Cayman put it up there for us. Didn't you, Cayman? I can't tell. 7.3, 2.5, 14.6, and 25. So
You just put up the answers from number 4.
oh, thanks, Cayman. You're right. I did do that. So just ignore that. I'm sorry. So what's
You're
the
fine.
answer? What's the answer for 5? And you could find this on page 685 if you're looking in your book.
I think Hendrik said it. Where the ratio is 20.
Oh, good. 20. But what does 20 represent? In other words, I'm going to type this in the box because it's important to understand what that 20 means. I'm going to type it in the box. In other words, a share of common stock of Jazz Company, or Jay's Company, I don't know how to pronounce it, was selling for 20 times earnings per share. So in other words, what was $20 price earnings? Okay.
Essentially, if like you're like be like talking like stock market terms, like say you put in $100, you'd actually be making like, what was that, like 2,000, something like that.
Wait, say that again.
Like, so if a share of common stock was selling for like 20 times what you're earning per share,
Yes.
so say like you put in like $100, would that like result in like a 2,000% increase, like a 20?
Well, $100 is your investment. We're talking about the market price per share, Cayman. That's a good question. So what's the market price per share of this stock that you bought for $100?
$25. So in total, you bought 4 shares.
You bought 4 shares.
So
Okay.
then if you earn 20 times that, you'd be like earning $80, something like that.
In other words, the share common stock was selling for 20 times earnings, but the earning is 1/4 of what you paid for it. So in other words, just take one share.
Mm-hmm.
So 1/4 of 25 is actually $6.25.
Gotcha.
Look at it. So you bought 100. So take 625 times 4 because you have 4 shares. So in that case, it would be $25 you would be earning on that 100 share because it's. Does that make sense to you?
Yep, I gotcha.
Okay. So the earnings are much less than what you paid for it, but that's still great. I'd love to have a share of stock that's doing that well. That's not bad. So the price earnings is 20, and a share of common was selling for 20 times the amount of earnings. So if we take 25, let me see, 25 divided by 20, let me just see. Goes 1, 2. So that's where they got the $1.25. You see how they got the $1.25, Cayman? They took the $25 market price and divided by the $20, which is what we came up with, the 20. And then that's how you get the 125, the earnings. So on one share that you spent $25 on, it's earning $1.25 per year. Hopefully it's paying dividends. Sometimes they don't pay out the dividend, they just increases the value of the share. All right, here comes the next one. Richards Corporation has, oh, did you put it in? Oh, you did. Okay, I just saw it. Thank you. Richards Corporation had net income of $250,000 and paid dividends to common stockholders of $50,000. So that's like 20%. It had 50,000 shares of common stock outstanding, meaning it's out in the street during the entire year. Richards common stock is selling for $35, so that's the market. The price earnings ratio is, so you're going to take $35 and you can divide it by 250,000 times 365. What do you get? Let's see if that's right. I'm going to put it in the box here. So it's $35, which is the market value, divided by 250,000 divided by 365 days. This is on page 684, just in case you're curious. Is that one of the answers? Oh, wait a minute. I did something wrong. It's my fault. It's my fault. I apologize. I put in the wrong thing. Let's do it again. Let's do it again. It's $35. I apologize. It's $35 divided by 250,000 divided by how many shares? How many shares are outstanding, scholars? How many shares? Unmute yourself so I can hear you.
50,000.
Yeah, good job. So let's do it again. That was my fault. Yes, yes, yes. Very good. Very good, Nidal. 7 is the answer. That's right. 7 is the answer. Let me just get over to the screen here. Good job. 7 times. So that's not $7. It's 7 times. Okay, so the purpose of an audit. The purpose of an audit, we learned from the notes, is to render an opinion. And that opinion, by the way, is in the form of a formal letter with the stationery of the public accounting firm at the top. So their name is on the line. When they're giving this opinion, they've got their name on that stationery. They don't want to mess up. So the audit is render an opinion on the fairness of the statements. All right. Here comes the next one. So what do you think the answer? Okay, I told you the answer, the purpose of the audit. So they're not trying to determine, notice it's determine, determine, determine. They're not trying to determine anything. The managers are responsible for putting those financial statements together. And the auditors step in and they come in and offer an opinion. In other words, you bake a cake, I'm a baker, I come in and I evaluate your cake. I have nothing to do with making the cake. You made the cake. But I come in, I taste it, and I say, I'm going to render an opinion. I think this cake tastes very good. And I think, it represents what a cake should taste like. So that's what it is. I don't want you to think that the auditor is putting together these financials. No, they come in after the financials are put together and they have to render an opinion. There's a big difference there. Okay, so now we're going to talk about the Sarbanes-Oxley. Very good. Cayman, thank you for helping me. That means I could stop early and just go relax for a while. I'm so tired. So which of the following is required by the Sarbanes-Oxley Act? So we talked about that. So it talks about price earnings ratio, a report on internal control, vertical analysis, common size statement. Which one of those choices do you think is the best choice? Type it in the box. B, that sounds good to me, Christopher. A report, very good, Hendrik. Anybody else agree or disagree with Christopher and Hendrik? Cayman, what do you think?
I agree with them.
So you're right. They give a report on the internal control, but that's not the only thing they do. That's one of the things the auditors do when they come in. And believe me, they stay there for like 6 months. This is not like an overnight thing and they're done. When they go to a company to audit, they bring big suitcases and trunks. It's like they're living there because I was an auditor. I know. So you are correct. But they also, they do testing. They do analyses. They give an opinion. Ultimately, when they're all done, they give an opinion on these financials. And then when everything is typed up, they will come in afterwards and just see what happened subsequently, just to make sure nothing strange happened where they might have to revise the financials. Okay, very good, very good. Excellent. And what is the Sarbanes-Oxley Act named after? Is it named after my dogs?
The two dudes that came up with the idea.
Yep, two dudes, the senator and the commissioner. Very good. So which of the following items should be classified as extraordinary on an income statement? Now, the reason this question is so near and dear to me is because this question was on my CPA exam, and I passed that exam. I took the exam more than once, I'm not going to lie to you, and I almost gave up. I almost was going to get out of accounting because I was frustrated. So I understand what it's like to be a student. I remember that. And my professor said, don't give up. He goes, you passed once before, you could do it again. Because when I took the exam, there was a rule that if you passed 2 parts of the exam, you had 3 years to pass the rest of it. 3 years went by and I didn't pass the rest of it. So I had to start all over again. And I was so upset. I said, I can't do this. I got to get out of this. And my teacher said, no, no, no. You did it once before. You could do it again. And he was right. I studied real hard. I had to tell my friends, I can't see you guys. I had to tell my children, I'll see you in 6 months. I mean, it was just, I had 2 children at the time, and I passed the whole test, and I'm so happy that I made that sacrifice. But it was a sacrifice. But these sacrifices, they end up paying back ultimately. But they are sacrifices, just like you're sacrificing now, studying. And I'm very proud of all of you. So, what do you think is the extraordinary item? But let me just give you a preface. Is a hurricane an extraordinary item in Florida? Is that something that doesn't happen very often in Florida? What do you think? Is a hurricane extraordinary in the state of Florida?
In the state of Florida, no, but maybe like in the state of like Colorado, it would be.
Okay, so very good. So now I lost my house to Hurricane Sandy, and I lived in New York at the time. That was in 2012. So that was an extraordinary item. If I had a financial statement, that would be on under extraordinary items, and they're shown a certain way on the financial statements because they're not part of the operations of business. They're other items that are shown below because it's not part of doing business. So yes, I lost my house, and that's when I decided. So lost from a hurricane in Iowa. So I think if we Googled Iowa, we'd probably find out, that Iowa doesn't have many hurricanes. Do you agree? I know they have.
I'd agree.
Thanks, Christopher. I know they have potatoes. Do they have potatoes in Iowa, or is it corn? I know they have something over there. Farmers over there. And they probably have tornadoes. They probably have tornadoes over there, but they don't have a lot of hurricanes. All right, so that's the answer. Now look what they have, the other ones. Gain on the retirement of the bonds. That's not extraordinary. Selling treasury stock for more than the company paid for it. That's not extraordinary. A loss due to a discontinued operation in Colorado. Not extraordinary. But a hurricane in Iowa. So let me just see. Could somebody Google that for me? Just say, are hurricanes usual in Iowa? Tell me what answer you get. Thank you, Cayman, for the last question. What do you come up with? Anybody? Hendrik? Christopher? What does it say?
It said there was one in 2020.
Okay, but what about before that? No?
I'm looking.
Does it say it's usual? Like, ask it, is it usual for hurricanes in Iowa? Ask it that.
I mean, the Wikipedia page for hurricanes in Iowa is literally 1 page long, so I imagine it's not.
Yeah, I think it's unusual. And we'll see what it says about New York. A hurricane's usual in New York. See what it says there.
Let me find out.
What does it say, Nick, Christopher?
I'm typing. New York's been affected by 84 tropical storms in this between now and the 17th century.
Well, what about hurricanes? Because you got to be careful.
Yeah, like the difference between tropical storms and
Yes,
hurricanes.
because you know why?
So,
Who's talking? Hendrik?
oh, my apologies. Go ahead. Sorry.
Hey, go ahead, Keenan. What do you
I was
see?
just gonna say, considering how difficult it is to find any information, like I've gone through like 5 websites so far, and I haven't found one that talks about more than 2 different occurrences of hurricanes in Iowa.
Talk about oh, okay, very good, very good. All right, so we got the message. It's not. It would be extraordinary if there was a loss from a hurricane in Iowa, because it doesn't happen all the time. Okay, or let's put it this way: in Florida, if there was a debilitating, incredibly deep snow frost here in Florida, wouldn't that be extraordinary? Because we don't have snow here. If there was some sort of a crazy storm that blew through and put ice and sleet, if we had like a sleet storm, sometimes the sleet can be the size of golf balls. That would be extraordinary, because Florida doesn't have that kind of stuff. All right, last question. Which of the following items appears on a corporate income statement before income from continuing operations? Which appears before income from continuing operations? The answer is income tax expense. So we don't talk about it very much in the class throughout the state. You know, we always showed the income statements. We never saw income tax, but in a real world situation, income tax can be a sizable material amount, and therefore it has to be on there. They have to estimate what the income tax would be, because usually at the end of the year, they file their return 3.5 months later. So they have to accrue what they think the income tax is going to be based on what they came up with income. All right. Does anybody not understand what I'm saying as far as income tax expense? You're okay with that? Let me see if I can look in the book. Anybody look in the book and see an example? I know there's an example in the book. Let me just see what page it is, and then we're going to say goodbye to each other. Let me see. Chapter 14. If you find it before me, let me know. Okay, good. I see it. I see it on page 691, Exhibit 14. Page 691, Exhibit 14. That's where you're going to see this display. And also, it even has different items on there. Let me see if it has anything about. I don't see anything about a casual, you know, like some. I don't see their example regarding an unexpected extraordinary item. I don't see that in the book. But anyway, all right, scholars. Any questions before I say goodbye to all of you?
I'm good. Thank you.
Thank you.
I have a question.
Very well. Keep it up. You don't only have a little bit more to go, and have a wonderful, wonderful Thanksgiving with your family. Give everybody a virtual hug or whatever. And
I think
thank you, Hendrik. I see your thumbs up.
I think Nidell was about to
Feel
ask a
better,
question.
Nigel. You got to get better, because you have to have turkey soon.
I have a question.
Nigel doesn't get my jokes. I'm only joking. I have a very bad sense of humor. Cayman, did you want to ask me something? You look like your face looks like you have a question.
Well, I do, but I think Nidell was about to ask you something.
Yeah, go ahead, Nigel. Talk to me.
Yes, thank you, Kenan. Regarding PQ11,
Mm.
there is a residual value.
Okay, PQ11. Hang on, let me pull it out. Hang on. PQ11. Yes.
Do we
There-
add the residual value to the net income, or?
Let's see. The residual value, that's a good question, was $15,000. You're going to have in your answer, you're going to have 2001, 2002, 2003, 2004, 2005. You're going to have all those columns, Nidell. The residual value is going to show up only in 2005, the last column.
With the net income, right?
Yes, and your net cash flow. No, it's net cash flow.
Okay, thank you.
So let me just tell you what the net cash flows are. So for 2001, you have 13,000. For 2002, you should have 12,000. For 2003, you should have 11,000. For 2004, you should have 10,000. And for 2005, you should have 24,000.
Okay.
And when you do B, do not forget to subtract the investment in the delivery truck when you're doing that calculation in Part B. And that was 55,000.
Okay, thank you.
Oh, you're welcome. All right, Cayman, did you have a question?
So for the comprehensive exam, I saw it was gonna be what, one question, I think, right?
Yeah.
And so is that going to be something we've already looked at in the past before, or is it gonna be like a random question that we haven't seen and we're gonna have to kind of evaluate it?
Is anything there? You mean I haven't put anything there yet?
Let me look.
Yeah, please, because there should be, it's in your book, and it's open book. It's open book, Cayman.
No, currently I'm not. Let me go under assignments.
Oh my God, it's not there. Thank God you told me. You know, whoever put this class together. there it-
Oh wait, never mind. Problem 9-2A on page 459.
Oh, is that what you see? You do see something?
Yeah.
Good, very good. Okay,
And so we just submit that. Yeah, that also for
please
the
put your name on it, Cayman. Everybody put your name on it. I get these submissions. There's no name on it. It's terrible.
with the DQ feedback,
Hmm.
the ones we sent via email, when should we expect those to be graded?
Well, as soon as I get it. Did I grade you? I thought I graded you already. If not, please send it again. You don't
I
hear
don't.
from me in 48 hours. Send me the email again. That means somehow it got lost in the sauce.
Yeah, I got you.
All right, Cayman, have a wonderful time. Goodbye, my good scholars.
Goodbye. Have a good
Okay.
Bye.